All right, things are being recorded now just for everyone's notification. We're going to be covering assignment 1 in this session, business 198, just because it's so new for us that I want to make sure that no one's left behind. And I know that I sent out a message this morning, and I know some people probably were not able to make it just because, it's such a last minute thing. And today, just a busy day a lot of times. But nonetheless, I'll record this so people can review it if they want to. And let's take a look at chapter 2's first question on the assignment, understanding the issues. And the first item on our list is item 3. About Paulo's company, right? Paulo's company. Kim, would you do us a favor and read that, just the first paragraph for us, please?
Okay, it's in the instruction notes or on Apollo's company.
Perfect. Yes, exactly. Paulo's company.
Okay. 1 second, I'm changing my book. Mine says, sorry. Are we on page 99?
98, because understanding the issues is on the left side. Yes, 98, please.
Okay. Sorry, 1 second. Apollo's company. Okay. It says Apollo's company purchased a controlling interest in Sanho's company. Sanho's had an identifiable net asset with a book value of $500,000 and a fair value of $800,000. It was agreed that the total fair value of Sanyo's common stock was $1,200,000. Use value analyst schedule to determine what adjustments will be made to Sanyo's account and what new accounts and amounts will be recorded if A. Senor's purchased 100%, Pablo's purchased 100% of Senor's common stock for $1,200,000, and then the B scenario is if Pablo purchased 80% of Senor's common stock for $9,600,000.
Perfect. Thank you for getting it started. Can you see my Excel worksheet?
Yes.
Outstanding. Okay, so I'm just using a random student's worksheet here. It's mostly blank, so I don't think I'm going to give away anything personal or identifying information, so it's okay with me here. All right, so in these problems, basically we have been given some information about parent subsidiary relationship, which we learned in this chapter, that at a certain level of your investment, accounting will change for you. In other words, if you are a small investee, less than 20%, then, and I'm going to jump over to this other exercise. Can you still see my spreadsheet?
Mm-hmm.
So generally, if you are a small investor and you've acquired less than 20% of the subsidiary, or excuse me, 20% or less than 20% of another company, you're considered to be a small-time investor, and really it's not a big deal. You don't really have too much in the way of controlling that company, and as such, you just record dividends from that company as you would if you were any other investor. However, things start to change, interestingly, when you acquire a certain threshold of another company, especially 20%. As soon as you cross that threshold of 20%, you start to be what we call an influential party. In other words, you start to have so much control over them that their decisions are not entirely their decisions. You have some say in it. And as such, the accounting records, accounting principles state that you need to start accruing their income on your income statement as if you were a significant party, and you are. And so you would record the ownership share of income from the other company, or the loss from that company as if it were your own, especially after 20%. And you'll record dividends just like you would any other day, but you basically have to record the share of the other company's income. That's a main thing you have to remember. And any dividend distributions are basically some distributions of the income that was pertaining to you. So you have to account for that by reducing your investment by the dividends. And we'll take a look at this specific example down the road. But for now, what I want you to remember, more than 20%, you need to start sharing and accruing income that the other company has made up to the extent of your ownership share. Once you reach a 50% level of ownership in another company, in other words, you are now the majority investor or the majority owner of a publicly traded company where greater than 50% share is required. That's when you will start to consolidate. Consolidate means that you will show that you own that subsidiaries. That's the word we're going to start using now. As soon as you have a greater than 50% share in another company that is known as a subsidiary of yours now, you're going to start to share income from the subsidiary. But not just that, you're going to show consolidated financial statements. In other words, since you're a majority of the owner anyways, it's deemed that that company is pretty much yours. And what you need to do is put things together. It's like this, as an analogy or as a simple analogy. If I were to go to Subway and buy, say, 2 sandwiches or 2 footlongs, and 6 inches of one of the footlongs belongs to one of my kids, right? My 9-year-old. I'm going to give the 6-inch Subway sandwich to him, and I'm going to keep the other 1.5 long for myself. Then when we leave the store, we put everything together in one bag, right? We don't say, okay, this is yours, you hang on to it, and this is mine, I'm going to hang on to it, walk to the car. We just put everything together in one bag, and we identify his piece of the sandwich as his piece of the sandwich by marking, his name on it or whatever, right? That's what consolidation really is. You're going to absorb all of the assets of the subsidiary, and whatever percentage you don't own, it could be 20, it could be 30, it could be 49, whatever, right? You will mark that as NCI, non-controlling interest, but you'll absorb everything else. And that's a consolidation process in just a short paragraph. It's definitely very complicated, and there are several chapters in this class dedicated to this process, and we're going to go through all of that ourselves, but we're going to go step by step. So now that you know some of the basics here, let's get started on this question with Paulos and Sanjoy Company. Does any questions so far?
One question: How does the subsidiaries relate to the merger account?
This is not a merger. So in chapter 1, we learned that there are different types of business combinations. Mergers are ones, and acquiring somebody else is another, where there's consolidation. What's the word that they used in chapter 1? Let me just double check. I want to make sure I get this right. Just a second. Acquisition, yeah. So mergers and acquisitions. Mergers are when like 2 companies merge and they come out with a new company. Acquisition or acquiring another company is where that company will continue to exist independently. You just are an investor to it, albeit, in the majority of the shares. So we can't say mergers anymore because now we are consolidating, now we're acquiring. So let's say acquiring. When you acquire a sub, what is a relationship? Is that what you asked?
Yeah, would that be that's the parent, correct? The
So if you're
parent
a
company?
parent, yeah, if you're a parent company and you purchase more than 50% of the subsidiaries' outstanding common stocks, does that not make you a huge or a major or the majority of the investor?
Yes.
It does, right? So you're the parent, and the subsidiary is called the subsidiary, or the company that you're acquiring a majority share in is referred to as a subsidiary. Does that help?
Yes.
Okay.
That just clears up some different terms that kind of confused me, had me going back to chapter one and then rolling over to chapter two.
Yeah. And so in a merger, we won't do any of this. In a merger, we'll just combine the two companies as if there were one company and move on. Whereas in consolidation, or when you have an acquisition, you basically absorb all of the assets, but you do identify the non-controlling interest that doesn't belong to you, that belongs to the other investors. All right, so in this problem, as I've stated in my notes, we compare the fair market value of the net assets that we have acquired with what we paid for it, right? In accounting, we're always focused in on transactions. So what did we receive, and what did we have to give up? This is
Mhm.
known as a value analysis. It is so important that we get this down because we're going to be doing this a lot in subsequent chapters. And I want to make sure that you guys are aware of how this is all played out using some simple examples, i.e. this question here. Number 3, understanding the issues. A gain is generally recorded when the price you paid is less than the fair market value of the net assets. What are net assets? Net assets are basically assets minus liabilities. When you pay less than what that amount is, not the book value, not what's on the subsidiary's books, but what is generally referred to in the market as the value of that company or net assets, that's what we need to compare things to. So if we paid less than that to acquire the share, then we have gotten a good deal, and we will call that some sort of a gain in our purchase, right? If you buy something, let's say you buy a Toyota Camry and it's worth $20,000 in the market, but you paid $15,000 for it, you paid less than what the fair market value is, then you made a gain on that, right? That was some sort of a benefit that you received.
Yeah.
However, go ahead.
Yeah. No, I was saying yes, I agree.
And if you paid more than $20,000, let's say the Camry's value in the market is still 20,000, yet you paid 25,000 for it, there must have been something over and above the fair market value that you thought was worth it, which caused you to pay that extra amount. Typically, we call that goodwill. A goodwill is recorded when the price paid is more than the fair market value of the net assets that you received in return. Okay, so this is known as value analysis. And because things can get really confusing really fast, we actually want to do this step by step. So can we do that? Can we do step by step here and see if we can make sense of out of all of this? Is it true? Is it true that they paid? And let me check this real quick.
St. Joyce, they paid
St. Joyce paid 1.2 million.
yes, they
In
paid one point
in
two.
part A, Paulos purchases 100% of San Joy's common stock for 1.2 million. So what did they pay? They paid 1.2 million dollars. I want you to
Yeah.
start in column G always, because in this scenario, we purchase 100% of San Joy's outstanding common stock. So there's no non-controlling interest. There's no little guy. We are 100%. So there's nothing left over for the little guy, right? No, we don't have to worry about the NCI. That's where the NCI is grayed out here. So parent price we paid was 1.2 mil. Let's go ahead and enter that here in cell G10, because that's where we want to start. Down the road, we'll consider the NCI column as well if our acquired share is less than 100%, but here it is 100%. So we're going to start in the middle column, and we're just going to simply put down the price we paid, otherwise known as the company's implied fair market value. And we're going to compare that to what we received, specifically the fair value of the net assets that we received. And this was given to us. They tell us in the second line, they tell us in the second line, the fair value is
800,000.
Okay. So that means the fair value of the net assets was 800,000, yet somehow we decided to pay 1.2 million for it, right? And we can just pretty much copy this entire analysis to this side. Excuse me. Boom, boom. Let me copy that. And we just need to paste that here because we are the 100%, and this column right here represents 100% of the company. So I'm just going to copy that over here. And it tells me that I paid over and above $400,000 from the fair market value of the company's net assets. This $400,000 is what we refer to as goodwill. As you'll see in the last line up here in the instructor notes, a goodwill is recorded when total consideration paid is more than the fair market value of the net assets. So the fair market value was 800,000. The amount we paid was 1.2 mil. The difference, 400,000, must have been because of the goodwill inherent in this deal. And so now I'm just going to simply copy that amount down here. And in conclusion, after this acquisition, these accounts will be increased by the following amounts. And basically, we have to now realize that we paid something over and above. And as such, this is known as goodwill. This is something that will appear on our books as soon as we consummate this transaction. We give rise to this thing called goodwill, and goodwill generally can only be created upon purchases. And so thus, this is a bona fide increase, and we'll have a new account on our balance sheet called the goodwill. And basically it's an asset. So it'll appear on the balance sheet side of things. It'll be called an intangible asset known as goodwill. And the only way you can really purchase or acquire goodwill, is by purchasing it. And in this transaction, that's exactly what we did. Now, the fair value of the net assets is a market value. However, on the subsidiary's books, you'll never see that amount. On the subsidiary's books, you're only going to see the book value. In other words, everything that company has been doing, everything that company has been purchasing over time will appear on their balance sheet, for example, using the cost that they purchased or the book value that they had. Whatever is happening in the market is out of their control, at least directly. And so the difference between what's on their books and what it's worth in real life must be computed now as well during this consolidation process, because now we own 100% of the subsidiary, and accounting principles dictate that at the end of the year, we consolidate all of our books together. And when we consolidate, we assume a sale has occurred. And even though right after the consolidation process, we're going to continue as two separate companies doing two separate things, on the consolidation date, at the year end, we must show, just for the purposes of disclosure to the investors out there, that we are one consolidated group. And then at that point, we'll need to increase the value of all of the assets that are on the subsidiary's books as book value. We'll need to increase that to market value, because in the eyes of the investor, on the consolidation date, a sale has occurred. So not only at that point will we have something called goodwill on the consolidation date, we'll also have an increase from the book value to the market value of the subsidiary, because now it's as if the subsidiary was sold to us just for that moment, just for disclosure purposes. Then the next day on Jan 1, the consolidation process will be ignored and the two companies will continue to move forward as separate entities. Does any of this make any sense? This is so complicated for the folks that are new to this class.
Yes, I'm following you.
Okay, you're following me. All right. So now we need to identify that. We have been given the book value in the second line as well as 500 thou. And we need to compare that to the fair market value of these items, 800,000. That's also given. Oops, 800,000. And so if you go back to that one particular activity that I had you guys do, if you recall that activity, in that activity, we had shown that there were different components to the selling price of a company. There was book value, there was an increase in assets, and there was goodwill. And so if you recall that, that's what these two columns represent: an increase in the book value and additional amounts that were paid. In other words, the book value is 500,000 plus, upon this theoretical sale, it hasn't happened in real life, it's just all theory, the subsidiary will receive another 300,000 increase plus another 400,000 increase. So 500 plus 300,000 plus 400,000, 1.2 mil is what they were paid for what they had in one go. So $1.2 million is really equal to 400,000 goodwill, 300,000 increase in fair market value from book value, and the 500,000 in actual book value that's given to us. Questions on any of that?
No, at first I was kind of confused when we got down to B, and it said company implied fair market value.
Oh, okay, you're running ahead of me, so you gotta slow down. Are we done with part A? Do you have any questions on part A?
No, I understand part A.
Outstanding. Now let's do part B. Let's assume that Paulos does not purchase 100%. Let's assume that they purchase 80% of the outstanding common stocks of Sanjoy for 960,000. Again, what did the parent pay? The parent paid 960,000. Again, I want you to always start in column G. I want you to put in 960,000. That's what the price that was paid. And I want you to jot down 80% apparent. Right now it is locked out, but generally I'll, in subsequent questions, I'll leave this cell G21 editable. So you can go in there and put 80% because that's what we purchased. Are you with me?
Mm-hmm.
So we paid $960,000 for 80% share. We paid $960,000 for 80% share. How can I explain this in an easy to understand way? Just a moment. Let me see if I can start making notes here. Did I not? Okay. Just a moment. Bear with us. Why can I not type here? Sure. Okay, good deal. All right, so if Miss Kim, if 80% of a company is worth, if 80% of the company is worth $960,000, then is there a way in the world we can figure out what 80% is worth? Is there any way in the world we can figure this out? Yes, there is a way.
Yeah.
If 80% is worth 960,000, 100% of the company must have been worth more than 960,000. Are you with me?
Mm-hmm.
And how much would that be? Well, we can set up an easy ratio where we can say, okay, 960,000, excuse me, 960,000 is equal to 80%. Percentage, thank you. So I'm kind of making an equation here. Then what is box worth, right? Or X or whatever. And again, this is something you probably learn in high school.
Mm-hmm.
And I wish I had a whiteboard. It'd be so much easier to do all of this there. Okay, so I'm going to set up my equation in such a way that I might be able to cross multiply and figure all this out. Do you see what I'm saying?
Mm-hmm.
If not, if 80%, excuse me, is worth $960,000, then what is 100% worth? And so if we set up the equation like this, then we can cross multiply things. We can say this times 100%.
It will be.
I'm just gonna copy that down. I honestly wish I had a whiteboard. It'd be so much easier. And the 80% remains at the bottom. So basically this whole thing is down here times 100%. Do you see what I did? Does that make sense? Okay. 100% is basically 0.1. So I'm going to put that there. And now I need to divide 960,000 by, excuse me, 96,000 by 80%. And we messed up somewhere. There's a zero missing. Let's just put 100 here, or just times 1. There we go. All right. So our calculation tells us that if 80% of the company is worth 960,000, then 100% of the company must be worth 1.2 million. And the way we did that is we basically cross multiplied, and then we divided both sides by 80%, which came out to 960,000 divided by 80%. In other words, you simply need to divide this by this number to arrive at what the total amount is. So I'm going to go this divided by 0.8. And sure enough, it's 1.2 million. Does that make sense?
Yeah, I'm writing down. Yes, I'm writing this down right now.
What if, okay, let's do another one. What if 960,000 represented 50%, right? Then 100% would have been the double of that. And so we can still figure that out just by changing this to 5. And sure enough, 960,000 times 2 is 1.92 mil.
Mm-hmm.
Just to prove, I can multiply that by 2, and exactly it's 1.92 mil. So it doesn't matter what these numbers are, as long as you divide these two, 960,000 by 80%, you will arrive at the total implied value.
Okay.
So if the total fair market value or the total implied fair market value is 1.2 million and you own 80% of it, doesn't that mean someone else owns 20% of it, specifically the balance?
Yes.
Right? If you own 80% of a certain amount, then someone else owns 20% of that amount. And so we can just go this amount times 20% and put it here. This is known as a value analysis when we own less than 100%. When we owned 100%, it was easy. We were the main or the only party. And so the company's, that was the company's fair market value. But when we own 80% of it, then we have to infer or calculate what the 20% is. so that we can chalk it up to NCI's share. To do that, we need to figure out what the total company's implied fair market value is and go from there. Did I lose you on this step? Because this is very, very important that you get this down.
So for us calculating the NCI, I know it's just the I know that that's like what someone else owns. We take our fair market value and we subtract it from what the parent price is, which is the 80% that they own. So the 27% that no one own is $240,000.
Right. Not no one, somebody.
Yeah.
Right? Somebody owns that. It's not
Someone own
nobody.
it, but yeah, we don't own it. The price that
We don't own it, and we don't care who owns it. And we will not make any attempt to figure out what's going on with that percentage. We just want to identify it as not being ours.
Yes.
Does that make sense? I love analogies, so let's go for another analogy if that's okay with you. Imagine we sit on a bus and I take up half of the seat. Then the other half belongs to somebody else. Does that make sense?
Yes.
Like, they have two-seater buses. You'd sit on one of them. Do you actually care who's going to sit next to you? No, I don't care who sits next to me. In fact, it has nothing to do with me. It's a separate person. But as long as I know where I'm sitting, that's all I care about. And so we're not going to make any attempt to determine what constitutes this 240,000, what it's made up of. We don't really care. We just want to know that we just want to identify that it's not ours and we do not control it. Thus, it's known as non-controlling interest. Are you with me?
Yes.
Now, things go back to the way they were, and we want to compare that to the fair value of all of the net assets. And luckily, they give that to us. The fair value of all of the assets are still 800,000, just like they were before. Are you with me?
Yes.
And so when I compare the implied fair market value, because when you purchase 80% of this company, what you're really saying to the world is that you believe that this company is worth $1.2 million in its entirety. One more time. If you purchase 80% of a company for $960,000, what you're saying to the world is that, in your opinion, the 100% of the value of the company is 1.2 million. And if that is in fact the case, and we compare that to the fair market value of all of the net assets which have been given to us, then we must have paid 400,000 in goodwill. Thus, we have just calculated the implied goodwill of our subsidiary, albeit we don't own 100% of it, but we've calculated the entire goodwill for them. They tell us that the net assets also have increased from their book value of 500,000, again, given, to 800,000, which then means that the difference must be the appreciation in assets, which would also, it's the same thing as before, right? 300,000, that's the same thing as before. But now we need to identify what the non-controlling interest share is of the company's implied fair market value, which is this one here. And since NCI owns 240,000 of it, we simply can say that their share of the fair market value is 240,000. So there are lots of steps in this problem, but I think each of them, if you take your time and do it slowly, will make sense. Why are we identifying the non-controlling share? We're identifying it so that we, first of all, because we don't own 100% of this company, we own only 80% of it in Part B. So the other 20% of whatever amount was implied must belong to non-controlling interest. And we have to identify that not only here, but also on the consolidated balance sheet. And so on the consolidated balance sheet for this company at the year end, for disclosure purposes, we're going to show investment in whatever company, investment in Sanjoy as an asset. And then you're also going to see goodwill on the consolidated group's balance sheet. And then you're also going to see increase in all of the net assets because of this purchase that we made. And you're also going to see in the equity side of things a line called NCI. In other words, non-controlling interest of the equity of the consolidated group, identifying the portion that which we do not have any control over. This problem is very crucial for all of us to understand, because subsequently we're going to move forward from here, but this will always be the first step in all these types of problems. We will always do a value analysis and determine, hey, the subsidiary's book value was apparently increased because we purchased it, so that no longer exists. How do we reflect that on the balance sheet in the consolidated group? That's really what a value analysis does for us. It helps us identify how much goodwill is. It helps us identify the increase from the book value to the fair market value of the subsidiary's net assets. And it helps us identify the non-controlling interest if one exists.
Yes.
Questions on this?
No, this was very helpful.
Outstanding.
Because as you go through the other problems, you see that the value analysis, it's what you have to do first before you can move on to the other steps.
That's right.
Which helps you unlock. It's almost like activity 1, but it's for exercise 2.
Yeah, it's like activity 1, but it's way more detailed now. Like we're actually pinning things down. Did you want to work on another problem? We have some more time we can work on. And by the way, when we get to chapter 3, I actually made a video for you guys on one of the problems, I think problem 3-8, excuse me, where I go through the same thing all over again, and then I give you a bit more information on how to deal with that problem. And that video is also coming forth. It's actually already available in module 2, because we've moved on to module 2. And so if you do need help in chapter 3, I have provided a video that I made specifically going through one of the problems. Please review that if you get stuck somewhere. In the meantime, is there any other problem that you want to work on that we can work on that'll help you?
Probably 2-6, 2-5 or 2-6.
2-5. Let's do 2-5 just because it introduces us to
thing.
Yeah, the D&D schedule. Let's take a look at that problem together. Let's take a look at that problem together. 2-6, exercise 2-5, excuse me. Exercise 2-5, purchase with a gain. All right. So, I mean, we've been dealing with goodwill mostly in all of these problems. This is a problem where we have a gain instead of a goodwill. And this time you're purchasing 100% of the company, so there's no non-controlling interest to worry about. We are the main parent. We're the only parent, and we are the only shareholder as far as the subsidiary is concerned. However, we don't wish to absorb or merge with that company. We wish to leave it alone and let them have an independent year. It's just we want to consolidate at the year end to disclose to the investors out there that we are one consolidated group, because of the accounting principles that dictate that as soon as you have more than 50%, you must consolidate. So since we own 100% here in number 5, we need to consolidate. Again, in this problem, we'll need to compare the fair market value of the net assets being acquired with what we paid. We did that in the last problems. This time, we'll need to record some sort of a gain because apparently we paid less than what the fair market value was worth. We'll read that in the question a little bit, and we'll need to look at what happens when there is an increase to the net assets. How do we do that? How do we do all of this? So let's take a look at this problem. Libra Company is purchasing 100% of the outstanding stock of Janelle Company for $700,000. 700. So right away, I start in column G. As always, we paid 100%. We paid 700,000, excuse me, for 100% of this company, Janelle, and thus we need to put that there. And basically, we can copy this entire column or set of cells to this right here. But let's finish off the fair value. Do they give us the fair value? They sure do. If you just jump the balance sheet on the bottom of this question, they say appraisal indicates that the following fair value of the assets and liabilities should be acknowledged. Fine. So we know now that net assets are simply assets minus liabilities. True or false?
True.
So thus, the fair market value of the net assets must be the fair market value of all of the assets minus liabilities, which is 300,000 plus 215 plus 700,000 plus 130,000 in intangibles minus 250 minus 210. Are you with me?
Yes.
And you see where I'm getting all these numbers from, right?
Yes, right here where it says appraisals indicated. I could calculate that.
Yes, you have to calculate that. I'm going to leave the 1,000 zeros off, and I'm just going to multiply the whole thing by 1,000. So just FYI.
Okay.
Just to make data entry a little bit easier. 130. Oops, why am I subtracting? Sorry, my fault. I need to be adding.
885,000.
Thank you. 130 here minus 250 because that's current liability minus 210 and close parentheses, multiply everything by 1,000. Are you with me?
Yes.
So the fair market value of something was worth 885,000, but we paid 700,000 for it. And it sounds like a good deal to me, right? If something is worth 885,000 and I paid 700,000 for it, then I made a gain on this acquisition. And thus this is known as a gain on acquisition, not goodwill. We didn't pay extra, we paid less than what this thing was worth. And then as such, I'm just going to copy that over here because we are the 100% share. There is no NCI, so we can just ignore that. Once we have done the value analysis, we will need to do something called the determination and the distribution schedule, which is new in this chapter. Basically, we will need to record this gain and any increase in the value of any assets or liabilities due to the fact that the parent paid over and above, the book value of the net assets. No, that's right. Even though we paid less than the implied fair market value, we still paid more than the book value, and we still need to figure that out. This can be done via the determination and distribution of excess schedule, known as a D&D of excess schedule. Again, it will compare not what we paid, but what the fair market value is compared to the book value of the subsidiary's assets, so that we can increase those assets for them upon consolidation. All right, so the parent price again is the same as before, 700,000, and it's the same for the entire company because that represents 100% of the company's implied fair market value, which we computed previously in the value analysis. We now need to compare that to the book value of what we received, or the book value of the net worth of the subsidiary. The book value of the subsidiary can be determined by looking at their common stock, their paid-in capital, and their retained earnings. One more time. The book value of a subsidiary can easily be determined by looking at their equity, specifically the paid-in capital, which is common stock and paid-in capital in excess of par, plus any retained earnings they have. And they give us all of this information, by the way. If you look on the right column, right side of the column, right below where it says liabilities and equity on page 101, you'll see the paid-in capital in excess of par, you'll see common stock, and you'll see retained earnings. We need to put that all down here. So 200,000.
300,000.
Thank you.
175,000.
And 175,000. Thank you, ma'am. All right. So we just filled that out. That was given to us. That's just basically the book value as stated on the subsidiaries shareholders category, specifically common stock, paid-in capital in excess of par, as well as retained earnings. And we just jotted it down. That's all we did here. Right? That's all we did here. And at this point, I want you to copy that total equity over into the parent price column. And I want you to realize that the parent owns 100% of it. True or false?
True.
Right? If there were NCI, then we would need to distinguish, we would need to distribute that book value between the two parties. But since we own 100% of it, this is all grayed out. We could just say that the book value that we received was 100% of the company's book value as stated on their books. So we own 100% of it. 100% of 675,000 is, of course, 675,000. Of course, that's the answer here. And now we just need to compare that to this number up here, 700,000. So if something was worth 675,000 on the books of the subsidiary, yet we paid 700,000 for it, that means the difference must have been the excess that all of these assets received in return. And of course, that's the same for the totality, because we own 100%.
So we paid.
Did I lose you anywhere?
No, we paid $25,000 more than what we could have paid.
What we should have paid, because we would typically want to pay whatever. No, let me rephrase that. That's if something was on their books for 675,000, we paid 700,000 for it, then we still gave them a better price than what was on their books by 25,000.
Okay.
I mean, however, this the fair market value is worth 885,000. So we still didn't really give them what they deserved. We gave them more than what their book value was, but they were really worth 885,000 in the market. You know what I mean? So we still gained on this deal. Now we need to identify how this $25,000 will be distributed amongst all of the assets, because upon consolidation, we're going to want to show the balance sheet as if a sale had occurred of the subsidiary, because in fact it did. That's what the consolidation assumes, right? We need to see the fair market value upon consolidation. And once the consolidation process is over, the two separate companies will continue their separate ways. Their books will be just the way they were. This assumption that a sale has been made is entirely theoretical. And as such, it'll only exist on the consolidated balance sheet or the consolidated financial statements just for informational purposes. Still, if an investor wanted to know what the consolidated balance sheet looked like, You don't want to be like, oh, we're not smart enough to figure that out. We don't want to say that. We can say, hey, you know what? Even though it's theoretical in nature, this is exactly what was paid and why things were paid. In fact, they tell us that accounts receivables were worth 300,000 on the books of the subsidiary. True or false, Kim?
True.
And the accounts receivables fair value is 300,000. So is there any changes needed to AR? No. What about inventory?
No.
Inventory had a book value of 200,000, yet in the market they're worth 215,000.
A $15,000 change.
That's right. Outstanding work, Kim. 15,000 pertains to inventory being increased. Let's leave this distribution key stuff alone for a minute. Let's just figure out column E first, if you don't mind.
Yeah, that'll be better so we can
Fixed
get through.
assets. Thank you, ma'am. Fixed assets are generally PP&E. Their book value is 500,000. Their fair market value is 700,000. Can you see that?
One sec. Yeah, I see. Property, plant, and equipment. Yes.
That's an increase of $200,000. Are you with me?
Yes.
Computer software. Book value 125, fair market value 130, a difference of 5,000. We need to identify why this $25,000 exists. So that's what we're going to do. Premium on bonds payable. All right. Bonds payable were 200,000. Right now, they're worth $210,000. You have a bigger liability or lower liability, Kim?
We have a lower liability.
One more time. If you had bonds payable that were on the books for $200,000, but now all of a sudden you have to pay $210,000 to get rid of them, that means you have to pay 10,000 more. And that should be a negative.
And this is when you say we're determining why we have that $25,000.
That's right.
And that's because we have more liability.
That's because on this specific item, on bonds payable, what is the book value?
On bonds payable, the book value is 200,000.
Yet the fair value is 210,000. Can you see that?
Okay, I see.
So we have to pay an additional $10,000 from our pockets to absorb that liability, right? It's worth more now. If you owe somebody some money and all of a sudden you find out you owe them even more, is that good news or bad news?
That's bad news.
Bad news. That's a negative right here. And then gain on acquisition, we already determined up above. Gain on acquisition was 185,000, and that's already a negative. So I'm just going to copy that down here. And when you add all of that up, you in fact end up with the difference of a $25,000 appreciation. That part is slightly tricky. That part is.
How do we get the $25,000 back?
Sure. You just make sure that these two items are negative, right? This item is negative and this item is negative. But yet when you add all of this up by simply going sum and then highlighting all of it and then just adding it all up together, you'll arrive at the $25,000.
And that's $25 back to us now. Well, back to our company value.
Yeah, it's like something on their books was worth something on their books was worth $675,000, right? In this line, we determined that their equity was worth $675,000, yet we paid $700,000 for it. So the $25,000 increase, why did that occur? That $25,000 increase occurred because our fixed assets went up by 200,000, our inventory went up by 15,000, our computer software's value went up 15,000. excuse me, 5,000. But all of this was decreased by the fact that our liabilities increased as well as we had a gain on this acquisition. When you put all of those pieces together, you will realize that the 25,000 increase wasn't just a simple increase in one asset. It was because of multiple factors. And now we have identified them. Thus, this schedule is known as adjustment of identifiable accounts. In other words, you're going to want to show all of these increases as well as decreases on the balance sheet of the consolidated group. If you wanted to increase, Kim, inventory by 15,000, would you debit it or credit it?
I would debit it.
Correct. If you wanted to increase the fixed assets of the value of fixed assets by 200,000, would you debit or credit?
Debit.
If you wanted to increase the value of computer software by 5,000, debit or credit?
I would debit it.
If I wanted to increase a liability by 10,000, would I debit or credit?
A liability, you would debit it.
If I wanted to increase,
Credit.
if you have more liability, right? If you have more liability, Kim, we would need to increase via a credit the said liability. True or false?
True. Anything pertaining liability.
Yep. And finally, if there's a gain, some sort of a gain on the income statement, would it be typically, would equity accounts, including income statement accounts, do they increase by a debit or a credit?
Credits as well.
So if we have a gain, we're looking at another credit. So I put in a formula for you guys, which concatenates these two columns and puts a debit in front of it. So this becomes debit D1, this becomes debit D2, this becomes debit D3, this becomes credit D4, this becomes credit D5, excuse me. Concatenating simply means put the contents of the cell together. So I already put in a formula for you guys so that you can have a roadmap. Okay, so when I do record the excesses down here, down the road, I'll know where to put stuff.
Because of the top part.
Because of the
Sounds
worksheet,
good.
yeah, right. Or you could have done this yourself. You could have said, okay, well, an inventory is being increased, so that's a debit. I'll remember that as debit D1. You know what I mean? But I just made that simpler for you guys so you can just see what you need to do here. And this is what the total distribution is worth, $25,000. So I'm going to put that as a D. That's what's going on down here. But before we, you know what? Let's just do that. Let's just do that now. Let's increase inventory by 15,000. Let us increase our fixed assets by 200,000. Let us increase our computer software by what we identified earlier, 5,000.
5,000.
Let us increase our bonds payable. Oops, we already have bonds payable there. Let us increase our gain on acquisition by 185,000. And I'm going to make this a negative just because there's already a negative there. Our premiums on bonds payable went up by 10,000, and our investment in Janelle Company went up by 25,000. So the sum total of all of the credits is 220,000. The sum total of all of our debits is 220,000 down here. I can confirm all of that. And now I'm done with that part where we have to actually record the excesses. And these will appear in the accounting system. So the inventory would have gone up, the PP&E would have gone up, the computer software's value would have gone up. The gain on acquisition, which will be eventually reflected on the income statement of the consolidated group, would have gone up by 185,000. The premium on bonds payable on the consolidated groups Liability section pertaining to bonds payable would have gone up by 10,000 because of this journal entry, and investment in Janelle Company would have gone up by 25,000 because it's like we just increased the book value of all of the subsidiary, and since we own all of it anyways, our investment has gone up.
Mm-hmm. Just taking what's above him.
So this journal entry basically records the excesses from the adjustment of identifiable account schedule up here. And the only thing now needed to be done is we need to actually move forward with the consolidation. In chapter 2, we learn that in consolidation, there are some things we need to eliminate. And there are going to be other questions down the road that are going to deal with elimination entries. In other words, when we consolidate, what we don't want to see is in the equity section, we don't want to see the common stock of our company and the common stock of subsidiary. You know what I mean? That is misleading to investors. We want to see one common stock line. So what we need to do is we need to destroy all of the common stock of the subsidiary. We need to destroy all of the retained earnings and any paid in excesses. We need to destroy all of that along with our investment in that company, because we are absorbing all of their assets. One more time. There's a lot going on here that we need to uncover. So in this entry, I'm going to repeat what I said. The elimination entries are required because in a consolidated balance sheet, Kim, I want you to imagine the balance sheet of a consolidated group. And in the asset in the stockholders equity section, imagine that you have information pertaining to the parent company and the subsidiary, and the parent company stock is there and the subsidiary company stock is there. And an investor looking at that consolidated group's financial statements, specifically the stockholders section, they're going to see two separate common stocks and they're going to get confused. What we want to do is we need to get rid of it. In a consolidation process, what really happens is that we absorb the assets and liabilities of the subsidiary and we destroy the investment in the subsidiary. One more time. In a consolidation process, we destroy the, let me rephrase. In a consolidation process, we absorb all of the net assets of the subsidiary while simultaneously destroying the common stock of the subsidiary and our investment in the subsidiary. Because think about it, the investment in the subsidiary account, an asset account, is that not really the common stock of the subsidiary up to the extent of our share? Yes, it is. And so in an elimination, so first what we do is we increase all of our all of the subsidiaries' book values up to what the fair value is. And then anything above that or anything pertaining to a gain or a goodwill, we record that. And then we destroy the investments and we destroy the net assets of the subsidiary along with their equity section. We absorb it all as our common stock and we get rid of the investment. One more time, let me explain it another way. I know we're kind of out of time, but this is, we're so close to being done. I just want to make sure that we finish strong here. Imagine, Kim, you owned investment in Apple, let's just say. And your investment was so significant that it was over 50%. By the way, you'd be a billionaire if that were true. And I'd be so proud of you. I'd be like, yeah, one of my student owns Apple or majority of it. But let's just say you owned Apple, more than 50% of it, and you had an investment on your balance sheet, on your company's balance sheet as investment in Apple.
Mm-hmm.
However, at the year end, you absorbed all of the common stocks of Apple as your own common stock and you showed them on your balance sheet as your common stock, then getting rid of that investment in Apple wouldn't be a big deal. True or false?
True.
Right? Because on your balance sheet, now you have all of the common stock of the subsidiary up to your extent of your ownership share, of course, identifying the NCI separately. But if you absorb all of the common stock from them, then having an investment in the said company is pointless because that's what an investment is. Right? An investment in Apple really means you own their common stock. So we absorb the common stock and we destroy the investment. Really, that's what the elimination entries are. And thus, the investment in Janelle Company, row 44, must be the investment that we credit because investments are generally debits visible on the asset side of our balance sheet, true or false.
True.
And if we destroy it, it'll take a credit to destroy that. Thus, the investment in Janelle Company is a credit. But before we get that far, what we need to do is we need to get rid of or absorb, we need to get rid of their common stock. We need to get rid of their paid in excess of par. We need to get rid of the retained earnings for them because these are all credit accounts. If you issue a debit to them, they will cease to exist. One more time. If I absorb all of the company's net assets, if Apple Company gives me all of their assets, doesn't that mean that I own all of the assets? And if that's true, doesn't that mean that their common stock and investment doesn't really matter anymore because I've absorbed it all? That's what's happening here. Upon elimination, we need to get rid of the investment. And I want you to kind of memorize this. Upon elimination, I want you to destroy the investment account and I want you to destroy the common stock of the subsidiary. In fact, I want you to destroy all of the stockholder equity of the subsidiary. And I want you to absorb all of the net assets. Then you would have completed the consolidation process.
So the goal of the consolidation process is to absorb all the common stocks and
Absorb all of the net assets. There are 3 steps to consolidation process. One, we increase the value of all of the subsidiaries' book value of their net assets, which we did in the previous step. The second step is to absorb all of their net assets, which we just did, which this investment represents. And we increased all of that. See, we increased investment. And then we destroy that investment and we destroy all of the common stock paid in capital and retained earnings. And we add all of their assets to our assets. Those are the steps that we take in a consolidation process. And some of these questions down the road will deal with that. Maybe we don't go any more than 2.5. No, we do have exercise 2. There's something else there. In problem 2-2, do we have a worksheet? Yeah, that's what we're going to do down here in problem 2-2. We're going to actually play that entire scenario out. We're going to actually destroy all of the subsidiaries' common stock and their other shareholder equity items. We're going to destroy our investment in the subsidiary, and we're going to absorb all of their net assets by taking our assets and adding their assets to it. Okay. So that is also a critical problem, 2-6, and it's very important that you work through all of this. If you need the time, please take it. I don't care. Just you need to spend time on this, reread the chapter, and again, reach out to me. I'll go ahead and sit again with you next weekend or the weekend after, and any other student that's interested, because this is so critical to this class. And I know how difficult this is. But You can do
Yeah.
this, Kim, and I will help you. All right. So we
Thank you,
destroy the
Professor.
subs. Go ahead, ma'am. I'm listening.
No, I said thank you for breaking it down. The book you could
Awesome. Awesome.
like
Awesome.
I feel like
Okay.
sometimes when you read the book, you're just reading information.
Yeah, this is so new and so difficult that at the first glance you're like, what? What are they talking about? But when you start
Mm-hmm.
to muddle with it step by step, it starts to come together. Here, we need to, in
Yeah.
this entry, we need to eliminate the investment in the subsidiary, which can be done via a credit, and we need to destroy the subsidiary's shareholder equity, which we're going to do in this entry. And so here, we want to destroy all of the common stock of the subsidiary given to us as 200,000
Mm-hmm.
for now. All of the paid in capital,
300,000
300,000.
in the retained
And
earnings
the
is
retained earnings, we're going to destroy that too. Yep, you got it. And we are going to destroy the investment. Um,
1 second.
Basically, we're going to destroy the book value right here. We're going to destroy the excess in the appreciation. And those two items will basically be our 700,000 price we paid, the fair market value. So basically, the investment does not exist anymore.
Because we destroyed it.
We destroyed the investment. We destroyed the book value of the investment and the excess of the investment. So the investment does not exist anymore. We destroyed the subsidiaries, shareholder equity, through this process. And then when we combine all of their assets to our assets, we'll have a consolidated group's balance sheet. You're going to see all of that play out in problem 2-2. This is a difficult problem and it's a lengthy one, but it can be done. So I'm going to jump over to that problem just to give you a pointer on how to tackle this. You're going to have the parent and you're going to have the subsidiary, and you're just going to add all of their assets together. You're going to add all of this together, absorb it all, and you're going to destroy all of the subsidiaries, and you're going to add all of this stuff to you while ensuring that these items get their due appreciation because of somebody came along and paid over and above the book value, and deal with any non-controlling interest here in this line. This seems daunting, and it is, but you're not alone. And I will again meet with you and any other student that's struggling with this. All I ask that you submit things to me the way they are by midnight tonight, and I'll give you an additional week to work on this. Go ahead and read the chapter back one more time, and all of this will come together for you. I promise you. And if not, we'll meet again.
Okay, thank you so much, Professor. I appreciate
I'm
this.
not gonna give up on you, Kim.
Yes, thank you so much, Professor B, for taking the time to just
My
give me
pleasure.
an
It is my
overview.
pleasure. I'm able to help. I know this is difficult. Don't be disheartened. Don't feel alone. I'm here. Work on this, muddle through it, power through it. I know you can do it. If you get stuck, let's meet again. Please reach out to me. But I do request that you submit this homework in on time by midnight tonight, because that was the extension that I gave to you. I want to make sure that nobody can point fingers and say, oh, why are you giving her extra time? Blah, blah, blah. I will be like, oh, well, I give everyone that extra time, and she needed more time, so I gave her extra time too. And then she needed help, I gave her that too. So I just want to make sure that no one points fingers and says, oh, you're being too nice to Kim. No, 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 I'm giving this time to everybody. But tonight's a big one.
Thank you so much, Professor.
So work through this week, and if you need help on any of these problems, we'll review them next session if you wish. I'll send out a timely announcement to the rest of the class, letting them know that help is available, that you guys can reach out to me for a Zoom session, and we can go through any problem that's bugging you. But I hope today's session helped.
It has helped me a lot. And you said submitted through email or submitted through our Canvas?
Till midnight tonight, you're able to submit it through Canvas. Please do that
Okay.
for documentation purposes. And I'm gonna go ahead and stop recording because this is all pertaining to you. Anyways,
Okay.
where did it go? Record button. Oh, buddy, where are you?